It's an urgent warning. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the U.S. dollar, as we know it, is about to come to an end in the next 10 days as the government begins structurally weakening the dollar. But this isn't the only problem the dollar faces, as we now have new reports showing that trillions of dollar-denominated assets could get dumped on the market, with this beginning potentially just this last Friday, which could send stocks and the dollar plummeting. We'll show you what you need to do to protect your purchasing power and your net worth, because this is our Sunday show, the show that makes you money, which is why we like to look at the technicals, momentum, and machine positioning of the broad equity, bond, currency, and commodity markets to help you make more money trading and investing. Plus, we have a sponsor for today's show. We'd like to welcome Science Biomedical to the show. You can find them on the NASDAQ under the symbol PBM, and they are the world's first life science biomedical company traded on the NASDAQ, focused on the development of botanical psilocybin-based psychedelic meds. Now, I'm going to show you a chart setup because this is a company you want to follow the news, because companies like them, you've seen their stock take off. I'm going to show you how you can potentially double your money with an investment in Science Biomedical. Stay tuned to the end of the show, or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where we picked today's story up with the headline: as China's yuan races 2024 losses amid broad dollar weakness. The big issue here is the dollar already is headed for its worst month this year as Fed rate cuts loom, and the market will soon start to price in even further cuts, which could send the dollar plummeting. But in the past, this has come to a safety trade as investors look to reposition cash into the equity market. But as you're about to see, there could be trillions of dollar-denominated assets dumped, which could send stocks lower. Friday was potentially a preview of what is to come, as Stefan Jen, the chief executive of Eurozone SLJ Capital, said last week that Chinese companies may be enticed to sell a trillion pile of dollar-denominated assets as the U.S. cuts rates, which could strengthen the yuan by up to 10%. The problem is, other experts have now come out saying that that $1 trillion number could only be half the real number, could be $2 trillion or more, as money looks to flow out of U.S. assets and the dollar back overseas. The theory goes like this: Chinese firms may have amassed more than $2 trillion since the pandemic in offshore investments, such as U.S. equities, and parked in assets that pay higher rates than yuan-denominated ones. And while the Federal Reserve lowers borrowing costs, the appeal of the dollar assets will erode, and quickly, depending on how fast the Fed cuts, and potentially spur a conservative, again, low-end number here of $1 trillion of flows back home as China's rate discounts with the U.S. narrows. And Jen, known for his work on the dollar smile theory, predicts the Fed will cut rates more aggressively than markets are expecting if U.S. prices continue to cool. That, along with an overvalued greenback, America's twin deficits, and the prospect of a soft landing, is bolstering his conviction the dollar will decline and send the U.S. economy into recession, which you can only imagine how much more borrowing will happen to try to save the U.S. economy, sending the dollar lower and lower. And that's why we now turn to Goldman Sachs, where we see the tactical flow of funds report indicating that what we saw Friday could just be the beginning of a massive sell-off in equities. And here we see Scott Rubner notes that he is bearish on U.S. equities starting September 16th. However, we're starting to see this thesis start to get pre-traded by market participants as we enter September. The question is why? It's because the second half of September is literally the worst week for the market in history. Every second half of September, we see stocks go down. And here you can see, based on his chart, he's saying we're here. And then all of a sudden, as we get into middle September, you start to see stocks head lower, as perhaps we're seeing some big traders who look to want to move their dollar-denominated assets out start to pre-trade this, because he notes the second half of September is literally the worst two-week trading period of the year for the S&P 500. We've been warning about this as we start to see flows coming out, and yet what have we seen investors do? Continue to aggressively buy stocks. And a lot of it has to do with corporate share buybacks, because corporates have come in and bought a massive amount of money with their stock under the last dip, and now that's starting to change. Why? Because we're hitting a blackout period soon. But it's not just corporates we see. We're entering September with local systematic length fully recovered, and I mentioned this, machines would go long here, and corporates heading to the blackout period, pension fund quarter end supply, and some mutual fund year-end important dynamics all looking to potentially send stocks lower. Here we can look at systematic exposure led by CTAs. We can see that in every instance going forward, they're going to be net sellers. This is a problem because as stocks go down, machines trade based on momentum. So when stocks are going higher, they continue to buy, but as soon as stocks go lower, they look to lock in their gains and sell, and then they get aggressive by going short if we see markets head down even lower than expected. And over the next week, we see in a flat tape, they're selling 93 million of global equities. In a down tape, only 33 billion of global equities. But over the next month, now remember, this is a key part because we get into that 2-week period and the blackouts. Look at this, in a down tape, you could see them sell 195 billion of global equities with 65.5 billion out of the US. You want to see a catalyst that could send stocks heading lower at a time when investors perceive a weakening dollar is bad. They look to reposition their money into risk assets. They're going to show you where you should be positioning your money instead. And we look at machine positioning in terms of the CTAs. I told you they were going to relever. They did. They're not at max length, but with the market rolling over and heading down, there is no chance the CTAs are going to hold this position, as you just saw. And it's not just CTAs, it's vol control strategies as well. They leverage back up, and as volatility rises, they will be looking to reverse their recent trend as well. But here's a big catalyst, because on September 13th, the corporate blackout window begins, and this is a big problem because it will start to wane into the September 13th blackout when 50% of the corporates will be there. They estimate 6.62 billion in passive demand from this group until blackout begins, and then it's gone. And that means, of course, we're going to see a 35% decrease in corporate purchasing power. They are the biggest marginal buyer of stocks, and without them, you're going to see stocks head lower because retail's piled back in, institutionals piled back in, everyone's gone in, and now you see the effect. The Fed looking to lower rates. People that are holding dollars want to protect that. They're going to look for an opportunity, but because the Fed is lowering rates, we're going to see potentially trillions of dollars flowing out of the U.S. A lot of that money went into stocks. Let's take a look at our screens here, because we're going to start with the S&P 500 as we do every week. We look at momentum. It is negative. How do we know that? The relative strength index. We want to see it under 40 to actually show negative momentum, but there's some other factors here. The MACD, or moving average convergence divergence, it's got a negative cross. But how do we know broadly momentum is negative? Well, we look at our own Momentum Timer Pro, which takes into account multiple technical signals, but we have a proprietary overlay we run. It's got 2 consecutive daily sell signals, and we can see down here, this is what you see on the actual report. The 1, 3, and 6 month windows of momentum are long and stretched. We're starting to see that reversal. And how about this? If you look at machine position, we run a report on that too. It's called CTA Timer Pro. We can see on our fast algorithm is selling down, even on our slow algorithm. In fact, we got stopped out for a 2.72% gain for our subscribers. And again, this is 100% duplicatable, and you get a 30-day free trial. You want to know how to trade the market. You want to know what sectors to be in. You want to make money trading. Look in the description below. Check out those links. And while you're there, check out Science Biomedical. You can find them on the NASDAQ under symbol PBM. Let's continue on here, because while we got stopped out for a gain, many people are going to watch their accounts head lower. That's a key. You want to control your risk. Let's take a look at the charts here, and what we see coming from the S&P is a double top here. You can see very clearly it did not get back to new all-time highs. It got close. It's rolling over. This is a red flag, because now you're looking at next level support is right down here at 523.29. You talk about the neckline. Well, that's right here. And how do you know it? Because that's where the volume starts to end. You see this big gap of volume. Once that goes away, you see price pressure to the downside. But the biggest risk is not in the short term. As we zoom out to the weekly chart, and I've warned about this before, on the weekly we've seen overbought, and I've suggested it's likely to roll over. We're seeing the MACD head down. We're seeing the RSI start to roll over. If that happens, we are looking at a much larger move down here, much like we saw back here in 2022. And it's not just the S&P that's flagging this warning, it's the NASDAQ as well. As we now turn to the QQQ, here we see RSI. Again, this is on the daily. Id now 37, suggesting momentum is negative. MACD's got a negative cross. Momentum Timer Pro, 4 daily sell signals on this, coming off pretty hot, long-term trends of rising momentum. Now, we got stopped out of our position here before, so we have no current position on this. And for good reason. There's a question is, why would we want to be long the U.S. equity market going into the worst 2-week period of the year with corporate buybacks coming? We don't want to do that with our trading account at all. You want to avoid that risk. And if you're thinking about your broad portfolio, well, we're going to show you some other assets you could use to perhaps hedge or protect against a larger downturn. But let's take a look at the NASDAQ here. Let's flip over to the charts. Let's look at the weekly chart, because what do we see? The same effect. You see an overbought territory, overbought territory, overbought territory on the weekly, and now it's rolling over. You see it on the MACD. It's running the same thing. It's starting to roll over. Unless there's somebody that comes in and buys this fairly aggressively, we're looking at a much larger pullback, potentially somewhere maybe even down here to the 200-day move. Actually, this would be the 200-week moving average, not the daily. We're not on the daily chart. Let's zoom out to the daily, and we see the next short-term target here, 439.87. You don't hold that, you're down to 421.57. Let's take a look, because you see right there, there's a 200-day moving average. Tagged it before and held it. If it doesn't hold it, well, we know that that is a red flag for the markets right there. But let's talk about small caps, because that changed too. But remember, we put a trade on this back on August 19th. We had to buy it open. Again, one of the best things about all of our subscriptions, 100% duplicatable, 100%. Can't do that with everybody else's support. In fact, you can't do it at all because it's impossible. But with ours, you can. We made a quick 0.68% return there in a matter of weeks. That was fantastic. You see momentum here shifting. We're worrying about this. You see the RSI, not below 40, but headed there. MACD's clear negative cross here. Again, if large caps are going down, you're going to think small caps are going as well. Let's take a look at IWM. What did we see here? A big rally. It didn't get up there. We said maybe last week we could see it touch that supply zone. Didn't do it. It's breaking down. 200-day moving average. Now the next target, 202.17. That comes right into play. If it squarely misses that, you're looking at a downside move here to around 188.52. You can see again, technical suggesting a much broader sell-off here is building. You look at the weeklies, it just really barely got to overbought territory. Nothing really exciting here, but remember, where the big caps go, the small caps will indeed follow. Let's continue on. Let's head over to the banks, because when we talk about Fed rate cuts, well, that is not exactly bullish for banks. In the short term, it's perceived to be that way, but it means financial conditions are tightening. Let's take a look here at KBE, because we had a trade on that too, but we got stopped out as well. 0.43% gain. You wonder how you trade things up here at the top? Well, there's ways to do it. You follow our subscriptions, you follow our stop loss data. We give you everything to duplicate this perfectly. But here we see the RSI at 47. MACD's got a negative cross. Momentum starting to shift against very long machine positioning here. But how about emerging markets? We took a bid on this and made a little bit of money, 0.42% on that. Again, completely duplicatable. Downside target now 41.18. We hit our downside target the first time. We think this is headed a whole lot lower. We notably machine positioning coming unwound. You see what Goldman's saying over the next month. We could see a large unwind. Emerging markets would be one of those that's going to plunge. You see this red line here? This is where the most shares have been traded over the last 6 months. It's broken. That means sellers are taking hold here and looking to send this down. You're talking about your first target at 41, our 200-day moving average. Next target down here at 39.50. That's a volume profile of the 1-year chart. But where can you go if you don't have bonds in your portfolio? Maybe you want to look to that to hedge your equity exposure. We're now at 5.91%. Remember on this trade, we were down because there's no way you'll ever get back to even. It's not possible. And here we are showing a near 6% gain. How do we do that? We just use the reports to dollar cost average in. Now, of course, we always recommend use stop losses when you're trading. But if you don't, or you made a mistake, just use the reports to dollar cost average in. You can see you'll get right back where you need to be over time. We see the relative strength at 64, but a negative cross on the MACD. Overall momentum still positive heading into that September FOMC meeting, where again the Fed is likely to cut. The question only here remains is, did the market front run this? Did it go too far? We'll find out soon enough. Let's take a look at TLT here, because what we see is it got right into that zone and hit our upside target there. Now what's interesting about TLT is you see this range here. There's a lot of sellers. People previously were buyers here. They came in, bought, and then boom, they turned into sellers. Everyone said this was over for bonds. Interest rates were going to the moon. We said not likely because, well, those people didn't understand how the monetary system works. Now we're looking at a potential breakout of all these people that are short here to drive bond prices up to this 109, roughly 68 level. You can see that high set right here. That's the risk to the upside. Will there be a pullback before that? Most likely, but that is the next path that will clear out. And from there, what you're looking at is the Fed aggressively cutting, and next thing you know, interest rates coming plunging down. On the back, of course, we know the machines are going to be positioned to take that and send it a whole lot higher. But we started the show talking about the dollar. Let's take a look at it, because the dollar is likely headed lower. We do not have position on this. In fact, it flagged on our reports last week, and I put in the notes to the subscribers, I don't want to be the long the dollar here going into a Fed rate cut. If you want to trade it, you can. I told them their upside target's a 200-day moving average. It didn't get there, and not surprisingly, but let's take a look at the dollar, because again, this is something I wanted to avoid. There's a 200-day moving average. I didn't think it was going to get there. I just said, hey, if you want to trade it, there's your upside target. It's not likely given the Fed rate cut. Let's zoom out here to the 2-year chart, because what are we going to see? The dollar. We're going to go further out than that. Let's go to 5-year chart. What do we see? Dollar headed down from about 28. You see the 5-year volume profile line. What that's telling you is all this above has been sellers, all this below has been buyers. But that means you break that, you're looking at this thing coming down all the way here around 26.72. That could be a massive sell-off. Could be a tailwind under the next asset class, probably the most important one. Where's the market rotating right now? It's rotating to commodities. Let's talk about soybeans. We flagged this to our subscribers here just the other day on August 27th. We had a pair trade, both CTA Time Pro and Momentum Time Pro flagged this. That trade up 1.8%. Here's our live stop loss level that we give our subscribers an update every week. And why were we interested in soybeans? Well, there's one very specific reason. It was down a bunch. In fact, anytime something is down a bunch, you want to keep an eye on for reversal. We caught this reversal right here. Now, how much upside potential does it have? That's anybody's guess. But for the moment, it ran into resistance at the 50-day moving average. If this does reverse and breaks through support, soybeans have got a long way to come down here to 19. At some point, could be one of those generational opportunities to see a reversal in commodities, and could happen on the back of a weaker dollar. But something we think is poised to take off. It could see your money doubling is the stock of Science Biomedical, our sponsor of today's show. Check them out on the NASDAQ under the symbol PBM. Everything in the pinned comment and description below. Let's take a look at Science Biomed here. Let's talk about their chart here, because when you see a stock deviate far away from its moving averages, well, it usually gravitates back to them. Here you can see Science Biomedical. It pulls down below that green line, which is a 50-day moving average, and then magically, boom, it comes right back to it. You see right here, it got to oversold territory in both the MACD and the RSI, and it came right back to the 50-day moving average. It's doing that again. It's in oversold territory. The 50-day moving average is sitting right up here at this volume profile line, creating a potential opportunity here for you to double your money. This is definitely company you want to watch the news for, because I'm showing you a little bit. These companies, when they put out some great news flow, you could see their stock take off. This is a risk capital play only, as Science Biomed, the world's first life science biotech company traded on the NASDAQ, is focused on the development of botanical psilocybin-based psychedelic medicines. The name science comes from the word psychedelics and science to affirm Science Biomed's commitment to an evidence-based approach to innovation as it works to develop safe and effective nature-derived psychedelic therapeutics to treat a broad range of mental health disorders. Science Biomed is initially focused on mental health disorders in the context of palliative care. And here you can see that research of psychedelics is gaining acceptance and momentum, which means it's going to find investment money, giving you the opportunity to get in here with Science Biomed at a low level where it's well below its moving average. Again, we want to suggest this is risk capital only, but it could see a potential doubling of your money as it heads back at some point to its 50-day moving average. average. And accelerating psychedelics, mergers and acquisitions are growing institutional investor interest, and money is flowing in looking for opportunities with companies that are making waves. We think Science Biomedical could be one of those. And some of the advantages of development of botanical drugs is they have differentiated FDA pathways, which is critical because this gives them benefits as designed by the botanical drug guidance. It has intellectual property advantages because it's very difficult to generalize. They have shorter clinical development, and efficacy and consumer preference are strong as naturally sourced active compounds appeal to patient preferences. As a recent paper published details results of preclinical study compared to biological effects of nature-derived psilocybin versus synthetic, and findings suggest that nature-derived psilocybin has a more potent and prolonged effect on neuroplasticity than synthetic. And this evidence-based independent finding further validates science's approach to development of nature-derived psilocybin. Palliative care is specialized medical care for people living with life-limiting illness such as cancer and heart failure, as patients in palliative care may continue to receive treatment as well as care intended to manage their symptoms. And palliative care is meant to enhance a person's current care by focusing on quality of life for them, their families, and their caregivers. As cancer patients receiving palliative care use significantly less healthcare resources, including emergency department visits, hospital admissions, and inpatient days, which is critical here because this is a focus for Science Biomed. And worldwide, 56.8 million people require palliative care, creating a potential opportunity for Science Biomedical to be the leader in this space. Of course, that alone could send their stock price rallying. As we look to other companies here, we can see select publicly traded clinical stage psychedelic comparable company descriptions in their market cap, suggesting that what we could see is on any big news coming out of Science Biomedical. Again, on the NASDAQ, on the symbol PBM, check out that chart. You'll see it's far off its 50-day moving average. And what could happen is news could quickly send that up there. Again, focus just on your risk capital with the potential to double your money. Let's take a look at some recent highlights. It's phase 2B ready assets, 25 milligram of psilocybin in conjunction with proprietary psychotherapy to be evaluated for adjustment disorder and life-limiting illnesses in the palliative care context. Leveraging benefits of nature-derived psilocybin, including potential synergistic effects of similar acting molecules not present in synthetic psilocybin. Near-term value-driven catalysts, including initiation of phase 2B trial in Australia, followed by first patient randomized, both anticipated in Q4 of this year. Again, suggesting watch the news for this company because it could send the stock price rallying in a big way. And multi-layered in-licensed IP portfolio with potential regulatory market exclusivity as new chemical entity, and a seasoned leadership team and board with significant expertise in successful drug development, putting Science Biomedical as potentially one of the leaders in the space of psilocybin-based psychedelic meds. Again, the potential opportunity here is with the stock so far off from its moving averages, could set up a potential for you to double your money and maybe even more, depending on the news that comes out of this company. You want to be watching for that in a big way. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.